Unless you've been traveling out of the country lately, you may not have noticed that the US dollar has been rising sharply since the middle of 2014. It's now at its highest level in 10 years. Even after such a big run-up, we think the bull market in the dollar has further to go, and if we're right, then it could have implications for your investments. In our view, the major reason for the dollar's rise is the relative strength of the U.S. economy. When an economy grows faster than others, it typically attracts foreign investment due to the prospect of higher returns on that investment. The U.S. is doing well, and growth has been accelerating over the past year. That's not the case for most of the rest of the world. The International Monetary Fund, or IMF, expects the U.S. economy to grow at a 3.2% pace in 2015, which would be the fastest annual growth rate in a decade. And it's twice as fast as Europe's expected growth rate and much faster than Japan's paltry growth rate. Emerging market countries are also slowing down after more than a decade of rapid GDP growth. The IMF is expecting the average growth rate in the emerging markets to fall to about 4% after running at about 7.5% over the past 10 years. A second reason for a stronger dollar is that U.S. interest rates are above those of most other countries. With the U.S. economy picking up, it looks like the Federal Reserve will be raising interest rates this year, while many other central banks are still trying to lower rates or find other ways to stimulate their economies. In fact, in parts of Europe and Japan, short-term interest rates are near zero or even negative. With the outlook for a stronger economy and higher interest rates, the dollar's been rising because foreign investors are finding it more attractive. Once economic trends like these get established, they have a tendency to last several years, and so do bull markets in the dollar. There have been two major bull markets in the dollar in modern history, in the early 1980s and in the mid to late 90s. Each lasted about 6 years. What does that mean for your investments? If the dollar continues to appreciate as we expect, then your U.S. bond investment should outperform foreign bond holdings. That's because some of the return from investing in foreign bonds is typically from the change in the currency. Emerging market bonds have historically been particularly sensitive to changes in the dollar because they tend to be smaller and less liquid markets. So when investors move their money out, it has a big impact. And even U.S. dollar-denominated emerging market bonds tend to underperform U.S. bonds when the dollar is rising because of the shift in money out of those markets. And finally, a stronger dollar is good for inflation because it tends to hold down the price of imported goods, especially commodities like oil. About 80% of the goods traded in the world are traded in U.S. dollars, so when the dollar goes up, it makes those goods more expensive to foreign buyers and demand tends to fall, leading to lower prices. Commodity prices are falling for other reasons as well, like slow global growth and oversupply, but a strong dollar can contribute to keeping those prices down. Overall, we see the dollar maintaining its upward trend for the next year or so, and that may mean that the U.S. bond market will outperform foreign bond markets and that inflation will remain tame. While you may want to keep your bond investments at home, with the cost of foreign goods and services about 15% cheaper than a year ago, this may be a good time for you to take a trip.